Hello and welcome to Next Exit. Today we have a fantastic guest in John Henderson, who has ran many deals on both sides of the table. Thanks for joining us, John.
Oh, thanks for having me, Dan.
I guess first up, it would be great to hear about you and your career. If you tell us about your background.
Best place to start at the beginning. So over the last 15 years, I've been in and around private equity in a number of different forms. And that all started off in KPMG, where I worked in transaction services as an advisor. During that time, my clients were private equity, so not a particular sector. So the beauty of that was I got to see all sorts of deals from, European football clubs to dairy producers in Africa, to pharmaceuticals, to manufacturers, to oil and gas, and everything in between. So it was a really good way for me to learn about lots of different industries and how people think about deals in different ways. After spending a decade at KPMG, I moved on to portfolio side, so working within private equity companies. And there I've worked across 3 different portfolio companies, primarily in the tech and media space, performing various different roles from starting up an M&A function and being the principal on a deal, to being part of the management team and actually leading the exits on a number of these assets. So that's just, I think, given me a unique perspective from being an advisor, a principal, and also then leading an exit from a management point of view, which is giving me a breadth of insight, I hope, over the last 15 years.
Fantastic. So it sounds like for your KPMG days over those industries, are those deals on the larger end of the spectrum?
They are. I think in terms of deals, I've done everything from maybe a 5 million deal to a 5 billion deal in my time. Okay. With the smaller deals being more in-house deals. So we're working, in-house M&A. And then when I was at KPMG, it was more the large cap private equity deals.
Yeah. And what would you say is the difference between running those 2 types of deals, or across the spectrum, I guess?
If I think back, I think the most difficult deal I ever did was around a 10 million EV deal. And I think that was due to the country it was in. It was a French business, so there was a lot of structuring and regulation challenges with it. The underlying business was and is fantastic. But I think all the work around how to actually acquire it, the legals, the tax, was hugely complicated for such a small business, whereas I've worked on deals which have been 800 million in EV, and they've been relatively straightforward because they've all been, say, a US or a European country. There's obviously more work goes into verifying the hypotheses for larger deals, but there's just as much work in getting things over the line, depending if it's a small deal or a large deal, it seems.
Right, okay. Sounds like the legal fees are almost as much as the company itself in that case.
Broadly speaking, the tax and legal fees are probably the same as EBITDA for the business.
Oh, fantastic. Well, very good. So I guess to kick things off for our listeners, it would be great to hear from you about if you had to build out a financial and operational structure from scratch at a high level, what would you be focusing on? What would you be thinking about in order to optimize the business and maximize the demand and the value of the next exit?
When I think about the finance function, particularly in a private equity sort of scenario, I think there's 3 sort of hats that I've put on. The first one would be, what is the strategic value creation plan, on how does the finance function play into that? Second would be the operational hat, keeping the lights on and making sure we're complying with all regulations, compliance, audit, tax, all that good stuff. And then the third is the commercial and the business partnering. So how are we driving the business forward? How are we reporting on profitability? How are we supporting the sales, the deals, the product, wherever the support needed in the business to drive it forward? So if I look at the 3 of those sort of separately, maybe touch in a little bit more. I think the first one I'll start with, because it is almost the building blocks and the foundations of everything, is the operations. For me, this is table stakes. You need to have really, really solid, clean financials. You need to obviously comply with all your tax and audits, etc. Make sure there's no red flags with that, because that instantly comes up as a warning to any investor or board member. And you got to keep sort of the lights on. So working capital management, making sure cash flow is good, paying for things, making sure the business can operate without having to worry about, collecting debts or chasing for payments to be made because there's some, it's not set correctly in the AP function. So I think to me, that would be the first area to focus to give you that solid foundation to build on. So obviously every business is different, but you're going to need to assess, okay, you need strong management accounts. You're also going to need a good payment process, collections. As they say, revenue is vanity, profit is sanity, but cash is king. And particularly in the private equity, and when you're potentially leveraged with debt, being really on top of your cash flow and being on top of your 13-week cash flow, your collections, your billing, super important. So that to me is always the starting point.
Okay.
And then once you got that settled, then you can build on, I probably shouldn't say this, but then you can build the fun stuff. So that could be looking at, okay, well, what data is coming out of our system? Now we've got the foundation. So can we do good retention analysis with clients? Can we look at profitability of clients? Can we go deep down on what we're selling? Where are we winning? Where are we losing in the market? How do we partner with the CEOs or the commercial leads of the business and get them to push for profitability or payment terms or maximize their revenue? Looking at new opportunities and assessing that. So then you can really build on that with the FP&A team, the commercial finance teams to really build out that sort of revenue drivers, profitability. Talk about the models and the forecasting and getting a really good understanding of how you can drive the business forward. So that would be the second area. And again, you're going to look at your FP&A, depending on the size of the business. That could be one person, that could be a team of 20 and beyond. You're going to think about the different countries, the different ways you want to partner. So there's lots of ways to consider, but that would be the next thing. And then thirdly, as my role currently is deputy CFO of MIQ, a lot of the time I spend is thinking about value creation and what is the strategy of the business and what we're doing as a business through a budgeting forecast, through decisions we're being made at a board level. How's that driving forward the overall strategy and the plan? And I think that's how you sort of tie it all together, really. Because if you think about a business, there's a number of ways you can drive value creations. One is just having really clean metrics. So that could be revenue growth, that could be EBITDA conversion, that could be cash flow. All those are really important to building our narrative that the company is strong financially. Then you're working in finance, you tend to be involved in a lot of decisions and a lot of operations. So, that could be, okay, we are expanding as a new region. How are we doing that? How are we controlling that? How are we making sure that is giving the results we want? It could be supporting on an M&A. Again, does that fit into our overall strategy of the business, or is this going to take us off pace and therefore not add value to the business? It could be working with the product. Are we putting our CapEx and our R&D development in the right areas to help drive the business forward? And then how do you then wrap all that up in terms of positioning? Okay, this is how we're driving the business forward. This is how we're reporting to the investors. This is how we're going to present it externally. And I think that then is the third piece, and taking all that good stuff below you in terms of the operations and the commercials and putting that together in a coherent story to tell investors and show there is a strategy here and this is why it's working and how it's working.
Yeah, awesome. So given that on the basis that you've gone into a company, build that out, how would you work with the different departments across the organization to be monitoring the KPIs, reporting them back up? What kind of a cadence would you set up to ensure that the board and yourself as the CFO would have full visibility of the organization without being too overbearing and spending too much time on reporting rather than actually creating value?
So the way I think about this is, Dan, it's not necessarily sort of strict rules around this, but what is the right framework or guidelines around this? The reason that I say that is because every business is going to be different. There's going to be times when you need to be really top of it. That could be you're having a difficult quarter and you need a regular cadence with a CEO just to go through, okay, what's the action plan? How are we turning it around? Or it could be actually, that the business is performing, but there is a focus on new product launch, or an M&A which is taking a lot of management's time, and therefore you need to be allowed for that in terms of people's time. So the way I like to think about it is setting up a framework. Okay, what is the rhythm of the business? So how do we operate? That could be, every month we have to report to the board of financials. Okay, then every month, and then you need a monthly pack from each of the regions or each of the business units, depending on how you set up the business. What are you reporting to the board? That could be, obviously financials are going to be important from a finance perspective. It could be what's going on with people, always important for a business. It could be key client updates. It could be anything else which is important. It could be a new product launch, etc. What I would tend to do would be, okay, we know we have to report every month to the board. We know what we report. Provide a simple template around, here are the numbers, here are maybe the people issues, the commerce or the client issues. Here are just some general points that you want to highlight to the board, be it, we've just won this new client, or it could be we spotted an opportunity to take share from this client by developing this product, etc. So whatever sort of the headlines that you want to feed up, have that prepared each month before you then go to the board. With sufficient time, if anything comes out of that, then you can phone up whoever it is. It could be the US lead, it could be the European lead, or however the business is structured, and say, okay, this is really interesting. Can you give me a bit more detail on that? And that is helpful because there's a way that you can automate that in terms of using different tools to pre-populate the financials and some of the key drivers, and then make it really sort of easy for people then to add in just sort of the commentary about what numbers aren't telling you, the insights, the people moves, or we have an opportunity in the market to do X. You can add that color to it. So that would be the sort of the monthly rhythm of business. So that would be something which I tend to do is look at automating that and then just diving in where it's interesting to provide that real insight, as opposed to just being the US grew by 10%. That's not super interesting to the board. The US is performing on par, but we've got this great opportunity in the Midwest where we can take share by developing this new product that we have, or you can really get into the detail.
Yeah.
And so that would be the rhythm of the business. I mean, obviously it depends. If you have a quarterly board meeting, you're probably doing that on a quarterly basis. I don't think you would be doing it any less than quarterly personally, but different companies have different setups. And then you've got other processes. So you'll have your annual budgeting process. So again, you start that depending on your cycle. First with a strategy session, so really getting to understand the strategy of each business unit and each region. Then you would go through, okay, what's your plan for the next year, and really interrogating that and make sure it stacks up, and does the cost investments match what the strategy is? Are we making investments in the right areas to drive the growth that we want from the strategy, etc. And then you would build that out. So that would be typically an annual thing for most companies, but then you might have to do it every quarterly depending on how fast the business moves or the market, etc. So again, that would be the other way you would approach it, would be, okay, what's the strategy of the business for the budgeting, and then how do you get through that? But then just taking a step back from all that, I mean, really any good sort of finance lead will want to build good partnerships and relationships with the other leaders across the business. So, you feel comfortable picking up the phone, or they feel comfortable picking up the phone, and it's actually these sort of unplanned or off the cuff conversations where actually you get the best interactions and the best insights.
Yeah.
So I'd always make sure you've got plenty of time in your diary to have these conversations, and always make yourself available, even if it's just going for a coffee and a walk with the UK CEO because he needs to let off some steam about some board comment, and you can then sort of talk to him about it.
Yeah, sure thing. Okay, that's great. That's awesome. So I guess just to discuss that a bit more, you've worked on both sides of the table essentially. Is there anything in particular from the private equity perspective they'd be looking at when, beyond the regular financial statements, any KPIs or any metrics they'd be digging into regarding the operational cadence of the business in terms of valuing it essentially?
The short answer is yes, quite a lot, Dan. I think the longer answer is it depends on the type of business. So if you are, say, a business services business, then there's going to be a lot around, okay, what are your staff retention, or the reasons of churn on the staff base? How much of an impact does that have if you lose one of your delivery people? How quickly can you replace them? What's your recruitment timelines, etc. What's the strategy in terms of where these people are based? Are you going to outsource them? Or are you not going to outsource them? Again, that all plays to value, because that drive cost efficiency in the future. And if that's the play, then you can do that. So that would be one example where the people metrics are super important because it's a people business, and that's outside the financials, but like really, really critical to how you run the business and how you effectively generate profits. Another thing which will come up time and time again when in any private equity deal is what are the market drivers and what's the market growth rates. So defining your TAM, your total addressable market, driving into SAM, your servable addressable market. And I've heard recently of a SOM, which is service obtainable market. So look at each of those in terms of who are your competitors, what's your market share, what's the growth drivers, are there any sort of opportunities, so tailwinds that can push the business forward, are there any headwinds and which are gonna stop. I mean, thinking about this from a experience, I was working on a pharmaceutical deal for a private equity firm, and it was selling, I guess, drugs all across the countries, but the biggest market was the US, and the FDA made a regulation change, which meant that they could no longer sell that drug in that market. And overnight, their, I guess, run rate EBITDA went from 100 million to about 40 million,
Right.
just by that change.
Yeah.
So that's an example of things outside which could impact you. So on the market side, so that's also a big area of focus. And the thing you'll hear again and again in private equity market is, what is your USP? Like, what is differentiated about this business? Why can't someone replicate it? That's always a fear as well, that someone can come and replicate what you do, and that's again super important.
Of course. So going back to that pharmaceutical deal that lost 60%, 60% overnight. Can you talk to what happened there?
So as sort of the normal way the deals came in was like, okay, we're looking at this pharmaceutical business, and the private equity house had been looking at it for about a month before they did their investment committee to get the approval to go spend on advisors. So they clearly been spending a bit of time on it, and a lot of work had gone into the materials. It's okay, we provided the materials, looked through, okay, understanding the business, how it works, okay, checking what was going on in the market in the background, and obviously this ruling came out. Okay, what impact that have? Okay, look at the financials, find the impact, calculate it, then say, okay, this is something I think we need to flag straight away. Our report was due in 2 weeks, but it's sort of 3 days in. So we get on the call. First reaction was always, no, you're wrong. This can't be right. You've misunderstood the business. You don't quite. We spent a month looking at this. Then taking a deep breath, explaining why you've come to this conclusion, taking the client through the numbers, seeing the penny drop, and they're like, yeah, this is a massive problem. Thanks for flagging it. And after that initial reaction, which was fair enough, they've clearly been spending a lot of time on it, they took a deep breath, said, okay, could you pens down, as they say, while we look into it. And then the following day, we got the confirmation that they were pulling out of the transaction off the back of this.
Okay. Wow. Well, it's probably the best advisory fees I've ever spent.
I don't think we actually charged them. I think it was we rolled on to another deal instead. A bit of
very good.
Yeah. So I think that was it was interesting, and I think what I found from that, which was really interesting, was actually they really, although they didn't like the news and they had that human reaction to it, later on you got the sense of, okay, we really appreciate you flagging to that and flagging it early. And it really did help build a strong relationship with that private equity house going forward.
Okay. Oh, very good. Very good. So you've worked on a large number of deals. You kind of touched upon it earlier on, over a few orders of magnitude, millions to billions, I guess. When looking at specific metrics, what do they care about most and what do they care about least across the spectrum? Obviously, like growth versus margin and anything else. Does that, to what extent does that differ from a deal in the tens of millions up to the hundreds of millions or billions?
In terms of the metrics, I think there's a number of ways people look at this. I mean, if I think back to maybe 3-4 years ago, revenue growth was seen as the best metric. Gave a sense of what's going on in the market, where the growth could be, and then anything around profitability or operations you could sort out along the journey, if you will.
Right.
So that was seen as the gold standard. what I've noticed over the last sort of 2-3 years is there's been a push towards profitable growth, in the sense that revenue growth just isn't enough anymore. What is your gross profit? How's that converting to EBITDA? And that's becoming more and more of a focus, from what I'm seeing anyway, with investors. That, okay, I look at valuations in the market, which I'm currently working in, and I can see that the companies with the rev growth, but those with the profit growth, are being valued a lot higher than the companies with just the revenue growth. Whereas, 2-3 years ago, they would have been valued the same publicly. There's a push towards profitable revenue growth. I think then you get into the nuances of the type of business. So if you are a startup and you are, say you're in the exciting AI space and you're going for market share, metrics such as, EBITDA will not be will still be relevant, but not as relevant. Metrics like cash conversion will not be as relevant, but things like, what is your ARR, your annual recurring revenue? What's your churn rate? What's the market growth forecast? Those will be big KPIs to validate as part of that deal. Whereas if you're a more established, let's go back to maybe to manufacturing as a sector, well, there will be growth in the market, but it's not going to be as exciting as the explosion in AI. So you're looking more towards, okay, what is your profit? What is the EBITDA growth? How are you converting your profit into EBITDA? Cash flow metrics, how are you going to fund this asset? How is it going to keep paying down interest in the debt, etc.? So then your cash metrics become a lot more relevant and valuable. So it depends where you are on that maturity scale. But the one which always gets the attention, because as I said, revenue is vanity, is that revenue growth.
Yeah, absolutely. You just touched on paying down the debt. There's been quite a bit of talk in recent months on all the PE-owned companies that have been held for quite a long time, 4 or 5 years plus, and because the market isn't where they would like it to deliver the next exit, they're taking on private credit. How do you think about that in terms of the business model changing, modeling the cash flow much more meticulously, etc.? If you're going from a pretty modest or no amount of debt to taking on more debt during that value creation journey?
Yeah, I think for me, the cash forecasting in any private equity business, because it's super important. It might be that you don't have much debt today, but if you're going to go on a journey, which is maybe a reinvestment, it could be M&A, it could be paying down the loan notes which the private equity firm has put in, which attract anywhere between 10 and 14%, quite chunky interest rates. So there's lots of reasons why within a private equity cycle you would take on debt. And therefore, I think it's always best practice to have that cash flow mentality and forecasting in from day one. So for me, I think the first thing is always to look at a 13-week cash flow. Whenever you're dealing with leverage, you need to have visibility on your quarter cash flows on a granular basis, because there are going to be movements in terms of big payments to suppliers, big receipts coming in. There's obviously tax, and etc. Potentially you do an annual bonus. So there's things that you'll have to manage and be on top of. And if it's the day before, then you don't really have much of a chance to react. But if you've got 3 months, then that allows you time to plan for it, strategize for it, and make sure you manage it appropriate.
Yeah.
I think in terms of the overall market, what I'm seeing is similar. I think the average hold for a private equity is now gone up to 6 years, whereas before it was maybe 4 or 5 years. So we are seeing that in the market, and interest rates are continuing to stay high. There was hope at the start of the year that the interest rates would drop, and it seems that with everything that's going on geopolitically has come back again to perhaps a modest drop in interest rates. So higher interest rates are here to stay. Leverage is going to be here to stay for a lot of private equity companies, and therefore the question is, how do you manage that? There's a number of ways to do this. I think the first one is working capital optimization. Lots of simple things you can do. Can you get your invoices out a day or two quicker? To maybe more complex strategies, maybe thinking about how you spend your cost of sales, for example, what suppliers you use, who's got better terms, can you consolidate and therefore have more purchasing power to give you more credit terms. So there's different things to do around that, but that would be a first place to look. Then you can think about, okay, well, how are we structuring our staff payments? Are we paying out a bonus every quarter, or we do it on an annual basis? So again, looking at how we compensate staff is something that's going to be the next sort of biggest outflow in the business.
Yeah.
And then you're thinking about, okay, well, what about the tax? What are we doing around our tax planning? How are we managing our tax payments as a typical outflow? And then also the shocks, the exceptionals, okay, we're acquiring this business and we need to spend $1 million on advisor fees. Okay, that's got to come from somewhere. So again, building in that flexibility.
Yeah, absolutely. And I guess unexpected costs are always higher than unexpected cost savings. So it's always the kind of downside to protect.
Yeah, we're very good at identifying what the savings are, but yeah, the people usually get quiet when the shocks come.
Yes, exactly. And that works on the revenue too. Obviously, I work a lot more on the sales side of things, and unexpected shortfalls in your sales are always a lot bigger than that kind of surprise last minute deal that you didn't know about. So I guess, have you got any other horror stories? You mentioned the pharmaceutical company, but have you got any deals that nearly didn't happen but did come through?
A few. I mean, I think they follow quite similar trends in some ways. So I was looking at a truck leasing company of all things, which was based out of the Netherlands. And to link into the cash point we were discussing earlier, very healthy, EBITDA, 100 million plus EBITDA. So you're there with the private equity principal. Okay, really like the profile of the business, strong revenue growth, strong EBITDA. And then you point out the fact that, okay, it might have 100 million of EBITDA, but it's got 120 million of CapEx requirements, which it has to fund every year. So therefore, actually, it's losing 20 million of cash every year.
Yeah.
So that was a really interesting, and we stayed up most of the night with the management team working through that and how to right size that to get the balance correct between investing in the fleet, obviously very important for leasing vehicles, but also making profit. And we worked out a good ratio, which would work for both the running of the business to make sure that was successful, but also in terms of financing and getting the deal. So that was a challenging balance to find between reinvesting back in the business. I mean, this is the ultimate example of a leasing business, but also making sure that there's enough profit to come out to pay for the bank interest, etc., or drive the business forward in other areas.
Yeah. Just dig into that. At what point did you find out about the CapEx?
So we were sitting in a management presentation and we were going through the overview of the business, the market. Being the finance advisor at that time, I did the natural thing of just flipping through the deck to the finance thing, just to do some quick calculations about what was going on. So whenever they got to the finances, I was prepared and ready to share either some insights or ask some questions to get the insights we needed. It was during that I noticed this and just gently nudged that towards the principal.
Yeah.
He quickly put his head in his hands, and then we quite quickly got onto that topic pretty quickly, because that was a bit of a gating item to the whole deal.
Yeah, absolutely.
But we worked it out, and the deal went through, and it was a success, which was good.
Very good, fantastic. So, how many exits have you worked on, and what do you reckon the aggregate enterprise value of them are?
If I think just about when I've been working in the portfolio side, so actually leading on the company side, I have done 3 exits with a combined EV of around 1.5 billion. Learned a lot from each of them, I'll say.
Very good. What were your learnings from them? These are pretty decent sizes.
I think in terms of learning, it's been going back to the setting up the finance function and tying it back to that. I think getting the basics of the data right in advance, so making sure the numbers are clean, making sure that every sort of KPI or thing you're presenting reconciles back to the source data which you're presenting. So having that foundation of data and clean numbers which are reconciled to, say, management accounts or financial statements, that are sort of super critical to the process, because without that, everything just falls through, and all of a sudden you start getting asked questions about the integrity of the numbers, and if people don't trust the numbers, then they don't have trust in the business overall. So that is sort of the foundation. I think my second learning is get more help than you think you need. The first time I did it, and to the extent the second time, I didn't fully appreciate how much work is really involved in it from a company side. So whenever I was working on advisors, like, okay, yeah, I know what's involved. I've seen it from the advisor's point of view, but that's just one aspect or one work stream. You know, if you're doing a sell side process, you might have 5 or 6 different bidders you're dealing with. You've got different work streams in terms of legals, tax, financials, commercials, the model, the marketing materials. There's lots of different work streams and they all have to converge at the same point. So it's not like it's staggered. It's all has to meet at the same point. So definitely think about what you need and probably add 2 or 3 or even double that resource, because you are going to need it. It is a big effort.
Yeah, sounds like it was a shock when you came over from the other side.
It was in a good way. I think it was. I think if I hadn't done it from the other side, I would have been, oh my goodness, I don't even know what I'm doing. But at least I knew what I was doing. It was just there was a lot of it to deal with.
Fantastic. So looking forward, what are you expecting to see from the market? Obviously, there's plenty of dry powder out there and a lot of deals to be done, but they just don't seem to be happening yet at the pace that people would like.
Yeah, I mean, I think you've hit the nail on the head there in terms of there's lots of dry powder we're here and lots of private equity backed portfolio companies which have delayed their exits for various reasons. So there's lots of pent up demand in the market and supply. I think the thing which is obviously causing the issues at the minute is the volatility in the geopolitical space. You know, be that Liberation Day and the tariffs when they were announced to, you know, we've got the Iran and Israel conflict going on at the moment. So there is a lot of volatility, and we're seeing that not just in terms of deal making, but just in business in general, that the appetite is there, but people are being cautious just based on what's happening. You know, how's that going to affect interest rates? Is there going to be a recession? So that is just playing in people's minds. And what certainly I'm seeing anyway is that the number of deals in this year has actually declined on last year and it's its lowest level since 2020. But the deals which have been done are some of the largest deals. So in terms of actual volume or size, it's actually gone up on last year. What I would take from that is that for good quality assets or quality companies, there is a market and there is appetite. You know, you say there's dry powder in investors. There are people out there with money to invest and banks with capital to deploy, but they're only going to do it in the top assets, the ones which command a premium, and those are the ones which seem to be coming to market at the minute.
Yeah.
And I think that's going to continue until the volatility dials down a bit, which thinking about this 6 months ago, thinking, okay, what's going to happen in the first half of 2025? I think things might calm down a little bit, and it seems to go the opposite way. So we can't really predict what's going to happen there, but once there is a period of stability, I do see that deal volume coming back.
Yeah, it's got to at some point. It's just, it's just a matter of when, I guess. But look, awesome. John, this has been fantastic to speak to you. Thanks for coming on and sharing your insights with the audience.
Oh, thanks for having me, Dan. It's been a pleasure talking to you today.
Thank you.